My name is Raed Shaybani. I am the country manager for Stashaway in the UAE, and I oversee MENA overall. I'm also joined by Michele, who is our co-founder and CEO. I will let Michele introduce himself as well.
Thank you, Raed, and thank you everybody for joining tonight. Very excited to be speaking about private markets, and the tone tonight is an educational tone. We're not going to try to sell anything, but just going to try to explain what it's all about. Right, I'll let you continue, and then I'll jump in later to walk through the various parts of private markets.
Perfect. Thank you, Michele. So a very quick disclaimer before we get in. As Michele had mentioned, this is not financial advice, and this is an educational session. And I think particularly for those that are not based in our 5 jurisdictions where we are licensed, please do consider this as educational. Like I said, we're not here to sell anything today, but very much to kind of inform everybody that's interested about about private markets as a space overall. A little bit just of context for those that aren't fully aware of our offering, just before we get started, is at Stashaway, we have a full suite of products and services to meet investors' needs. So we have cash management solutions, core portfolios, thematics, and our alternatives. On cash management, these are equivalent to your savings accounts, just better. They yield higher returns than what you would typically find from a bank here in the UAE. Our core portfolios are our managed portfolios, where essentially we diversify across asset classes and across geographies. You set your risk profile and we manage the portfolio for you. We have thematics, which are essentially portfolios based on specific themes. So if somebody has a thesis to say technology is the future, or consumer tech, or healthcare, we have preset portfolios for that as well. And finally, we also have our alternatives, and that will be related to the topic for today, where we offer private equity, private infrastructure, and private credit. All of these, not as products, but as asset classes, will be discussed during today's session. Now, the question is, why allocate to private markets in the first place? There are three key reasons. Number one is enhanced returns. So private markets overall can improve your risk return profile. And as you'll see throughout the rest of the session, in many cases, they actually outperform public markets, depending on the asset class. Number two is lower volatility. While, of course, with every investment, there's always some level of risk and some level of volatility. They are not strongly correlated to public markets and tend to have less sharp declines and rises in a very short amount of time. And then number three is broader diversification in general. Because they do not correlate strongly to more traditional asset classes, it's a way of strengthening the overall diversification of your portfolio to drive a balance of long-term risk return profile. Institutional investors overall, on average, tend to allocate about 23% of their portfolios to alternative assets. That while they aren't necessarily the core of a portfolio, they do help strengthen. Now, at Stashaway, a couple of things, just again, for those that aren't aware of how we provide an offering that is different to what you would traditionally find out there. If you were to ask people about private credit, private equity, private infrastructure 10 years ago, they would say they're quite expensive to get into, and they're extremely illiquid. You look at 7 to 10 year timelines. What has changed today and what we offer is, number one, these funds are all semi-liquid, which means after a short 12-month lockup period, you can subscribe or withdraw on a monthly basis. And number two, the minimum investment is actually very low. Traditionally, with these asset classes, the minimum would be $250,000 or more as an investment. With us, the minimum investment is only $20,000, and then follow-on investments are as low as $5,000. And capital is fully deployed into the funds kind of in one go. There are no capital calls after you've invested. In the case that you would like to learn more, please do reach out to us. Bhupesh, who has joined us today, is one of our wealth advisors. If you would like, you can scan the QR code or save the number and schedule a call with him direct. Over to you, Michele.
Thank you, Raed, and also thank you, Bhupesh, who's helping in the background. Maybe one thing before I start is, if you have any questions, during the presentation, please use the Q&A button that is available on Zoom. And at the end of the presentation, we'll try to go through the question that comes up. Okay. So as mentioned, tonight, it's the way we're thinking about this is educational, and we're going to try to cover private markets in a sequence. So let's start what the core question. Let's define private market. Let's see what is the perimeter we are looking at. And you might have heard some of these words. So let me and I'll use these words later on in the presentation. Let me explain a little bit what we're talking about. So buyouts are the core part of private equity, which is a sub part of private markets. So private markets, actually, let me make a step back. Private markets means investing in assets that are not traded in a stock market. So when you invest in Apple stocks, you're investing in public markets. If you buy Apple bonds, you're probably investing in public markets as well. If you're buying a REIT, you're investing in real estate through a publicly traded instrument. When you are buying something that is not traded publicly, that's a private market transaction. And from an asset class perspective, that can be equity, it can be credit, or it can be other real assets. So let's start with equity. So private equity. So buyouts are the core, but the bigger part of the private equity sector and potential investments. And what buyouts means is a private equity fund buys a company, usually with some sort of structure where there usually some credit involved, but from the perspective of the private equity fund, you're investing equity to take control of a company and own and manage the company. Usually those investments are done in established companies that generate cash. Usually there is leverage that is put on the company, so you need cash generating companies. And the goal is to improve the performance of the company. There are many examples. The one that is listed here on the slide is Burger King, that has been flipped a few times from private equity investors. Now, second, venture and growth equity. From an investment type perspective, is similar to buyout, so it's equity going into a company. The difference is that it's focused on earlier stage companies. So it's focused on not yet mature company, often not profitable companies, showing extremely high growth rates. And here, therefore, the goal is to be able to benefit from this growth. So you probably, read in the press, the main investments that are going to, OpenAI and Anthropic these days, or Uber as a few years ago, as you see in the slide. So those are all investments in venture or growth equity. Stashaway, for example, when we started 9 years ago in Singapore, we raised money from venture capital investors. We raised money from people like Sequoia Capital and Eight Roads, and those are all venture capital investors. Now, let's move to credit. So we now spoken about equity, and we kind of split it into mature companies and earlier stage company. Let's move it to credit. So private credit means invest in the debt instead of the equity of a company. In many cases, this is part of a private equity transaction where part of the cap table or the capital structure is going to be credit. And those are loans given to the company. And it can be, a senior loan or a junior loan, depending on where you are in the cap table. I'm going to go into details and explain this further in a second. Real assets are obviously another type of asset class. You can invest in physical assets. It can be infrastructure, it can be real estate, it can be natural resources, and you can do this with private capital. So similar logic. You're investing. In these cases, in some cases, you're looking for yield generation. In some other cases, you're looking for kind of infrastructure developments. Usually, the infrastructure investment tend to be focused on providing yield for investors. These are what people call primary investments in private markets. Secondaries are which means that the money goes into the company, into the asset, and kind of to get ownership of the assets. Secondaries are when there is an acquisition, for example. So let's talk about private equity secondaries. When a private equity fund buys the shares of a company from another private equity fund. So that's a secondary transaction. Or, if you can be one level higher and actually buy pools of private equity ownerships from another fund. So that's called a secondary transaction, and that can happen also in credit and in real assets. And obviously, then direct investments is when instead of investing in a fund you are going directly to a specific company. So, practice going one level lower into the buyout structure or the private credit structure. Let's start with private equity, and I'm going to talk about private credit and private infrastructure in a second. So I'm going to follow this structure as we just discussed. So let's talk about private equity. So Ray earlier said, why would you want to invest in private markets? And the first thing he said is to enhance returns. So let's look at the numbers first for private equity. What you see in the chart here is the returns of the last 25 years, so this is a quarter of a century, of $1 put into the MSCI equity world. So this is global public equities versus a benchmark for private equities. And as you know, the light blue, as you can see, the light blue line, which is private equity, has tremendously outperformed the public equities throughout this 2.5 decades. And as you can see, it actually, obviously there's been a lot of compounding on the delta, but as you can see, there's actually has been constantly outperforming, so that the distance between the two lines grows over time in a fairly constant fashion, with obviously a spike between 2020 and 2022. So, the concept here is better returns over time. Now, Ryan also spoke about diversification, and what he said is, look, you're investing in asset classes that are uncorrelated to the public equities, and this is true, and I'm going to speak about that in a second. But on top of that, you also getting access to the majority of companies. What you see on this chart is the percentage of companies that are large company above $100 million in revenues that are public or private. That is, as you can see, in every geography is north of 80%. In Europe is even north of 95%. Are private. So if you only invest in public equities, you are leaving on the table the diversification potential of 85-90% of companies are large companies globally. So again, diversification also means getting access to larger kind of a larger pool of companies you can invest in and you can get access to. Let's talk again about value and returns. While 25 years ago, a lot of value was built after IPO. If you look at Amazon went public quite early. And private investors, so the VCs that invested very early in Amazon days, only made 10x, made 10x returns at IPO. But if you actually bought at IPO shares, so when the company became public, you made more than 1,000 times your money. So most of the returns for Amazon came when the company was public. This is not the case anymore. If you look at the example of Google, Meta, Alibaba, but obviously this is going to be the case also for OpenAI and Anthropic and name a company. And the actual majority of their returns has been happening when they were a private company. So companies are staying private for longer, and a lot of the value is generated when they are private. Okay, so it is important to get access to that value creation side as well. And what you see on the bottom right, for example, is the average size and age at IPO. And as you can see, this is done by decades. As you can see, it's been growing. So as I mentioned, companies are staying private for longer and going public when they are already more mature, which means they've already accumulated a significant amount of size. Now, who invests in private equity? And until recently, investing in private equity was actually not super easy. And it was really the territory of institutional investors. And Ray earlier shared that 23% of capital of institutional investors on average is invested in private markets. If you look at Harvard Endowment, Yale Endowment, Stanford, if you look at ADIA in here, or Mubadala, or the Dubai Investment Authority, or Temasek and GIC in Singapore, and obviously the list go on, you'll see that a very significant portion of their investments are in private markets. And so as you can see here, public pension funds, funds of funds, corporate pensions, endowments, family offices, all of this invest very heavily in private equity. And as mentioned by Ray, that the average investment in private markets is north of 20%. Actually, if I remember correctly, Yale has been one of the more aggressive proponent of investing in alternatives over the last couple of decades with extremely positive returns. Individuals, and I'm not counting individuals that have more than $100 million, let's call them family offices. So individuals that have less than $100 million have been underinvesting in private equity. And in particular, individuals that have less than $10 million have historically had in practice no allocation to private equity. Now, in recent years, it has been more possible to get exposure to private equity. And so some people have started to invest in private equity. However, the traditional channels of the bank still provide for high minimums, sometimes north of $150,000 per deal or per fund, and very high fees. And as mentioned by Red, what we're trying to do here is making it much more accessible, both from a minimum ticket perspective, as well as from a fees perspective, as well as from a liquidity perspective. So that the idea is that private individuals should be able to invest in private markets similarly to what institutional investors do. Again, looking at returns and in particular looking at risk here. So what you see on this chart is the excess returns of the average private equity versus S&P 500 in different public market regimes. So when the S&P 500 is done, has booked different type of returns. What you see on the left side is when the S&P 500 has done less than minus 5%. So when the S&P 500 lost money more than 5% in a year like that, on average, actually, this is a 4-year, actually, average 4 years. On average, private equity have done 9.8 percentage points better returns than the S&P 500. When the S&P is done between minus 5 and plus 5%, private equities have done 6.9% more than the S&P 500. When the S&P is done between 5 and 10%, private equity is done 8.2% more than the S&P 500. And then the delta goes down to around 3% in the years when the S&P is done very well, between 10 and 15% and greater than 50%. So two messages here. One is that across all the situations, private equity has outperformed public equities. And these numbers are from 1995. So this is 30 years of data. It's a long, long, long history. Okay. The second message is that because the outperformance tends to be better when public markets don't perform particularly well, this means obviously that there is less volatility. So it reduces your risk overall. Because when public markets tank, your private equity allocation will actually tend to sustain valuations better and keep your portfolios afloat over time. So again, Raed talked about diversification earlier. This is a bit of a mix of great diversification, reducing risk, while at the same time enhancing returns in every market condition. So I'll stop here for private equity. If you have any questions on what I just said about private equity, feel free to write them in the Q&A box on Zoom, and I'll be certain to go through that at the end of the presentation. Let's move to private credit. As I mentioned earlier, private credit means that a private credit fund, lends money to a company. Okay, so this is not a bank, it's a private credit fund. And this is usually a privately negotiated deal, which means that the company has some sort of specific needs, and while a bank will have a kind of cookie cutter approach and try to have one product that needs to fit everyone, private credit will be able to actually build a structure that hopefully works for the company while providing good returns for the private credit fund. From an investor perspective, this is an asset class where people invest in order to get good cash flow, and I'm going to talk numbers in a second, and with strong downside protection. Obviously, depending on which piece of the capital structure you're invested in, again, I'll speak about it in a second. Especially if you are investing in the more senior part of the credit portion of the capital structure, you actually have a lot of downside protection, because in practice you are the first money that comes out of the company if the company has any value at all. Even in a downside scenario, in a bankruptcy scenario, you might be the first one to get paid. Okay. Now let's put together briefly buyouts and private credit, and let me explain to you kind of a good case and a bad case scenario and what happens to returns. So let's assume that there is a company and a private equity fund wants to buy it for $100 and decided to fund this company with $40 of equity. So $40 comes from a private equity fund, and then goes to two private credit funds. One gives the junior debt and the other one gives senior debt. The junior debt fund will give $20. The senior debt fund will give $40. Okay. Now, let's say that 5 years later, there is a sale of this company. And let's start from a good case scenario. In a good case scenario, the company that was originally worth $100 is now worth $200. So the company's improved they grow, they improve their margins, and they reduce their cost, whatever. I mean, the company is just worth more right now. And so the $200 need to be split. And the senior debt will get paid fully the $40 that was initially paid. And because at the 8% interest rate that was paid throughout the years, it would have received $16 of interest over the course of these 5 years for a total of 1.4 times returns. Okay. The junior debt will have received its own interest, let's say it was 10%, because it's junior, we're going to get a bit more, so it's going to get its own interest over time. And equity will get whatever is left. So 40 plus 20, $60, $200 come in, so equity will get the remaining $140. So the private equity fund will have made a very good return. The $40 will have converted into $140 over the course of 5 years. Great returns. Let's do the bad case. So the senior debt gets exactly the returns that was contractually agreed. The junior debt gets the return that were contractually agreed. The equity gets all the upside. In the bad case scenario, let's say that now the company is worth $50. So if it was $50, the senior debt will get its full $40. So in practice, we'll get exactly the same amount of money that would have gotten in a good case scenario. The junior debt will get $10 because that's what's left, and so we'll actually lose half of the original money, and equity will be wiped out and get zero. So what I'm saying here, I'm not trying to say that junior debt or equity are bad and percentage debt is good. What I'm saying is that the type of volatility and risk you're taking on is very different depending on where you invest in the cap table. And so when you look at investing in private markets, we want to understand in details what exactly you're investing in and where is this money going in the capital structure of a company. While this is very simplified, it's actually more or less how it works. So, this is actually a good representation of reality, even if obviously it's extremely simplified here. So what that means is obviously the private equity is higher risk, higher returns, while private credit tends to be low risk, low returns. Again, depending on where you are in the capital structure, expected returns are therefore higher for private equity and slightly lower for private credit. Private equity tends to have irregular distributions. In some particular cases, it might be more regular, but usually it's irregular. While private credit usually pay a coupon on a quarterly basis, for example. Duration for private equity are longer than for private credit, 5 to 7 years on one side, 3 to 5 on the other side. In a kind of negative scenario, the private credit is the most senior claim on the money. So it's the first money that comes out, while private equity only receives money if there is anything left. And then from a fee perspective, private equity tends to be more expensive than private credit. Again, not trying to tell you that one or the other is better. I invest in both. If you are a high net worth individual and you are trying to complement and diversify your portfolio, it might make sense to look at both asset classes to complement your overall portfolio. Now, I mentioned a couple of times that it depends where you are on the cap table, on the capital structure. And in reality, let's look at private credit strategy by looking at 3 different possible characteristics. The first one is, what is the type of borrower? So you need to look at the size of the company. Are you invested in a very large cap? Are you invested in middle market companies? Are you invested in very small company, mom and pop's company? Obviously, the risk is different and the profile is different. Are you invested in private equity-backed company or entrepreneur-owned company? Again, different risk profile, different sophistication of the shareholder you're lending money to. Are you invested in businesses or invested in real asset type of companies or type of asset as we discussed earlier? Are you invested in asset-backed businesses? So is there an asset that you can take ownership of if the company doesn't work out, or it's an asset-light company and therefore there is a bit more risk? You can look also at seniority, we said earlier, senior debt, junior debt, equity. This actually is done in a bit more detail. So it actually split the senior debt in first lien and second lien. So the first money out is first lien, then second lien, then the mezzanine, then preferred equity, and then equity. Okay. In some cases, there is a unitranche, which means the first lien and second lien are merged together. And then lastly, and very importantly, the financial conditions of the company you are investing in. Are you investing in performing credit, which means that the company is doing well and can easily sustain the debt servicing? Are you investing in a in a stress company without a controlling influence, so you're just buying some credit? Are you investing in a distressed company and you're taking non-control, so obviously this is riskier? Or you're investing in a distressed company and you're getting control, so you're trying to, in practice, restructure the debt of the company and taking full ownership, to maybe perhaps taking equity ownership of the company at that point in time. Again, understanding where the funds you're investing in invest is crucial because it has a big impact on your risk return profile. Here is a table that summarizes a little bit what we just discussed. From the top to the bottom, it goes from low risk to high risk. I'm not going to read through all of that, but obviously it has an impact on your target returns. It goes from 7, 8, 10% for senior debt to north of 15, 18% up to 20, 25 for restructuring assets. This is obviously on a deal by deal basis, and the reality that if you invest in a fund that does restructuring, you will know that some of the investments might not do well, and therefore you need some investments to do particularly well in order to pay back for the ones that don't. So we talked about private equity, we talked about private credit. Quick reminder, if you have any questions on either of the two, please use the Q&A button on Zoom, and I'll get to the questions in a second. Third, let's talk about real assets. So what are real assets? I mean, the definition is pretty clear, right? So it's a tangible, hard assets that usually have a value because those assets are used for something. It can be a building, so real estate or land. It can be a different type of infrastructure, a park, train stations. Right now there is obviously in the UAE the Etihad rail being constructed, so all the train stations are public transportation assets, and somebody is investing money to build those train stations. That's a private infrastructure type of investment. Obviously, there's going to be a strong government input as well. Natural resources, farmlands, mines, and other assets of this sort. Sometimes also agricultural assets are considered for investments. And we need to differentiate the kind of economic infrastructures. These are the transport, the train stations, the railways, the ports, the electricity infrastructure, and usually these can be partially funded by private funds and private infrastructure fund. And there is also social infrastructure which usually is paid through taxes by the public sector, or in places where maybe there is large endowments, in the public endowments may be paid by that. And this is where the services are for the public good more than to create an economic infrastructure. Obviously, private infrastructure is a very broad term, and you need to go into more details on what are the industries within private infrastructure that you're focusing on, and different funds will invest in different industries. It can be, it can be power and energy, it can be energy transitions, which is renewables, it can be transportation and logistics. The example I gave earlier on train stations and railroads, or the airports, etc. It can be digital infrastructures, the fiber optics, infrastructure, as well as cell towers and data centers. Obviously, there is a lot of investments going in data centers right now with the very large demand coming from artificial intelligence, as well as environmental, waste collection and processing, water treatment, etc., etc. Again, these are a major subsector. Each of them is actually very, very large and attracts disproportionate amount of capital, both private and public. So why invest in private infrastructure? Because you can actually have significant returns, with very low correlation to public equity. I'm not going to go through the details of the numbers. You can read them yourself, but we're talking about potentially north of 10% returns with relatively low volatility, and it's usually a good hedge against inflation with low correlation to public markets, so it fits well into a diversified portfolio. So why invest in? So we kind of went through the three building blocks: private equity, private credit, private infrastructure. Let's go back to the original question. So why invest in private markets. This is, again, a bit of more detail on what we discussed earlier on what $1 have done over the last, this is only 10 years, in the different sectors. And as you can see, private equity has overperformed S&P 500 as well as MSCI Equity World. Private real estate and private credit have done well. As you can see, the volatility of private credit, for example, the golden line, is significantly less than the volatility of private equity and S&P 500. And the reason is what we discussed earlier. You're investing in a different part of the capital structure, and therefore kind of looking for slightly lower returns for less risk. Obviously, as in every asset class, you're not going to have, other than cash maybe, you're not going to have the same return every year. There's going to be better periods, worse periods. So what this slide shows you is the highest and lowest 5-year annualized performance for a few asset classes in the last 30 years. So this is a very long time. And so let's look at the top curve. As you can see, VC and growth, as you can imagine, has the highest performance, positive performance of more than 51% per year during the 5 years that ended in Q3 2000. This is just before the dot-com boom. And when equities, also private equity have also done well. Developed market buyout is kind of a segment of private equity, has done 27.5% annualized, actually in a similar period up to Q2 2000. While if you look at it on the credit side of things, private credit has done just a bit more than the Bank of America High Yield Index, which is public, and quite a bit more than the Credit Suisse Leveraged Loan Index, which has done 13.5%. Now, the most interesting thing, though, is what you see at the bottom, which is that the lowest performance for developed market buyouts is positive. Even the worst trailing 5 years have been positive at 3%, while obviously MSCI Equity World has done negatively, -7%, -6%. As you can imagine, venture tends to be more volatile, and so actually is the worst of the bunch. As you can see, is actually the exact 5 years after the top, the 51% that I mentioned earlier. So, from Q3 2000 to Q3 2005, that's where the -12.7% came about. So that's why if you invest, the more volatile the asset class, the longer you want to invest in the asset class, because there's going to be periods of up and down. On the credit side, the difference is even more stark. So in the worst 5 years, private credit still deliver 4% per annum, which is actually not a terrible return, especially in tough times for credit. While public credit, both measured by the Bank of America as well as the Credit Suisse indices, actually have lost money in the worst 5 years over the last 30 years. The point being here that private credit and private equity, especially especially buyouts in private equity, tend to create more stability for portfolios by having less volatility, especially on the downside, while providing great upside in good times. So, recapping a little bit, why add in private markets to your portfolio? First, returns, so potential outperformance. Over the last 3 decades, private markets have outperformed public markets. Today, you can target, high teens for private equity if you go in for an illiquid structure, and you can target 12 to 14% if you're going for a semi-liquid structure. On private credit, depending on where you are on the cap table, you can target anywhere between 7% to 15, 17% for semi-liquid structure, depending on how much risk you want to take. And private infrastructure, similarly, you can target somewhere in the 10 to 15% range or 8 to 15% range, depending on what type of investments you're looking at. Those are all kind of a double-digit type of target returns, which obviously make for an appealing introduction into your portfolio. Second, lower volatility and correlation with public markets. So 2 different things. Like one is they tend to be less volatile. The worst 5 years are better than the worst 5 years of public markets. And oftentimes they're not correlated with public markets. private equity is more correlated with public markets than private infrastructure, for example. So kind of going away from pure equity to credit and infrastructure helps even further. But even private equity is not very correlated with public markets. So when you put it in a portfolio, it will actually simply improve significantly your overall kind of risk-adjusted returns. 3, and connected to this, lower potential drawdowns because of this lower volatility, the overall maximum drawdowns tend to be lower. So in times of stress in your portfolio, think 2022 when public equities went down 18% on average, private equity, so public credit went down 18% as well on average. Private equity and private credit actually held up pretty well, and so it would have reduced your overall portfolio volatility because of lower potential drawdown. And lastly, again connected to this, it just creates gives you the exposure that otherwise you wouldn't be able to get. Those are not assets you can get in a public market. Those are assets that you can only get exposure to if you invest in private markets. And so as your net worth grows, you will want to explore areas to kind of for further diversification and further protection of your assets. Now, how, and I'm just another reminder, just in case you have questions, you know how to do it. There is a Q&A button in Zoom. Now, let me close with talking about how can you invest in private market? How can you access private markets? Traditionally, private markets have been illiquid, and a traditional private equity fund, and private credit are slightly faster but not very dissimilar. But let's talk about private equity for a second. Have a 12, 18 months kind of fundraising period, followed by 4 or 5 years of investment period, followed by 4 or 5 years of divestment period, followed by 1 or 2 years of potential extensions of the fund life. What it means is that if you commit today $100 to a private equity fund, it will take 3 to 5 years to invest those $100. So the capital call, you will not invest $100 immediately. You will invest maybe $20 now, $20 next year, $20 the following year, etc. And it will take around 6 to 7 years to break even, meaning to get back your $100. Obviously, I'm talking about a well-performing fund. And then you're gonna get another 3 returns in the following 3-4 years. Now, the good side is that returns will be potentially significant. Again, I'm talking about good performance here. The bad side is that this is illiquid, right? And it's money that you can't touch for a very long time. And this is the traditional way. Now, there are now structures called evergreen fund or semi-liquid funds where the capital is fully deployed. So your $100 are deployed immediately. You don't get capital calls over a few years. There is some level of liquidity. It can be either monthly or quarterly, which means that you can actually withdraw money if you want to, and you're probably going to be able to withdraw money pretty much at any point in time, except in period of extreme stress. So in March 2020, probably you would not be able to withdraw because the funds are getting. So remember, the underlying is illiquid. So the liquidity is created on top. And so in periods of high stress in the market, you might not be able to actually liquidate your investments. But again, in the last decade, probably the only time where you would have had some problems liquidating investment would have been March 2020. So it is infrequent, possible, but infrequent. Evergreen fund can, depending on the structure, they can help you get very diversified exposure through a single allocation. So you can have one fund, depending on the structure, obviously, but you can have one fund investing actually across a variety of different managers, for example, and therefore creating diversification with one fund only. Maybe I will stop here. And as you might have noticed that I haven't spoken about the StashAway private equity, private credit, and private infrastructure semi-liquid offering. And the reason I'm doing this is that today in the call, there might be, not everybody is a registered professional investor, and we can only offer those funds to what in the UAE is called a professional client or professional investor, which means you have more than $1 million in financial assets. And that's why I cannot speak in detail about the funds. I'm just speaking about the asset classes. If you are eligible for this and you're interested, you can get in touch with Bupesh. Maybe I'll show you once again his contact details in a second. Or we're also going to have a more in detail webinar only for professional investors, which is going to go live on the 29th of October, so in a couple of weeks from today. And obviously, feel free to reach out if you want to have more information about that. That's going to be open only to professional investors that have opted in, and therefore, where we can go into the details of our offering, which I do believe is by far the best you can find in the UAE, but honestly, anywhere I can find from a cost perspective and structure perspective. So let me see if there are any questions. So Eric is asking, what's the minimum funding requirement to invest in this? I don't know when you wrote this, so I don't know what this meant, but let me actually give you a broader answer, Eric. So traditionally, private equity funds and private credit funds had very high minimums. North of $1 million, often more than or north of $5 million. Now, in recent years, the banks are trying to reduce that, and you can go to a bank and invest in a closed-end fund for sometimes 200,000, 150,000, 250,000 minimum. With Stashaway is actually bringing it down a notch. And I think this is something that is not fund specific, so I think I can talk about this. And Ryan is nodding, so I can do that. The minimum we actually do is $20,000 to invest in either private equity, private credit, or private infrastructure. So we've reduced tremendously the minimum tickets. I hope I answered your question, Eric. Feel free to follow up if you have any other question there. So there is another question here on kind of portfolio management. What is the percentage of allocations to private markets that you see people allocate to? So obviously, I cannot give advice today. I don't know who you are. I don't know your portfolios. What I can tell you, and we talked about institutional investors investing on average 23% in private markets. I'm not going to tell you this is the right number. I can maybe tell you what I personally do and kind of give you a broad perspective. So personally, I do actually I'm close to the 23, 25% similar to institutional investors, and I split it across the three different sub bullets. So this includes private equity, private credit, private infrastructure. I think about these as my longer term investments. I have a core portfolio. This is where majority of my money is. I have cash, where I have also my kind of my emergency funds, and then I have private markets investments to kind of juice up the return. And I know that those are longer term, even if they are semi-liquid. I have no intention to kind of liquidate them at any point in time. I'm just, those are there to accumulate and generate higher fees. Now, obviously, if you want to go into a more in-depth discussion on your portfolio, and depending on your age, your liquidity needs, your overall net worth, this and also your risk propensity, these answers may change. And I'm sure Bupesh would be very happy to have a session with you and go through these and give you some perspective on how you can think about this. So there is a question on how does the Fed rates play with private equity markets? So, and here is private equity. So I was going to say it depends on which private market you're looking at, but the sub is asking about private equity specifically. So what happened when the Fed cuts rates, for example, which is what people expect the Fed to do in the next 12 to 18 months, a few things happen. From a private equity perspective, first, cost of funding reduces. So cost of leverage in a private equity transaction goes down, which means, therefore the equity ownership has more leverage. So this is a positive for private equity. In general, the economy tends to benefit from lower Fed rates. Then obviously you can have lower Fed rates as a result of economy going badly. So depending on what's happening first, the answer might change. But if the Fed rates reduction helps the economy avoid a recession, That's good for the economy, and that's therefore good for the companies owned by private equity as well as public equities, to be honest. So this is the same. So it is a positive on the funding side, and it is a potential positive on the quality of the business of the outcomes of the business underneath invested, but that obviously depends on the overall economic situation. Generally speaking, lower rates play well for leverage play, and this is a leverage play, so it tends to be good. Now, for private credit rates tend to be floating rates on a base, on SOFR. So when rates go down, the gross nominal returns for private credit tends to shrink. What private credit funds can do to make sure that their returns are more constant is they actually can change their capital structure to have more debt in their own capital structure, and that's what some funds do to maintain similar level of returns with lower or higher interest rate. But on average, because interest rate go down, you might see some reduction in yield for private credit. I hope I answered the question. How is this private equity, private credit taxed for European citizens fiscally resident in the EU? I mean, first of all, if you live in the UAE, I strongly recommend that you move your fiscal residence to the UAE if you can. But if you can't, it depends on the country where you are. So if these are gonna, depending on the country, depending on the jurisdiction, this will be accounted for as capital gain for you, similarly to any other global investments you might do. So the structure is, again, similar to any other global investments you might do. The structure you will be invested in, I shouldn't go into much detail today for the reason I mentioned earlier. So if you want to maybe go into the details of how the structure works for Stashaway, get in touch with Bhupesh. He can help you understand what is our structure, and then he's not going to give you tax advice, but then you can actually kind of look at it from the perspective of your country of fiscal residence and look at whether the structure is actually favorable or not for you. In general, from my understanding and my experience, it's taxed as capital gain in your jurisdiction. And obviously that's I'm assuming majority of people connected here are resident in the UAE. One of the gigantic advantages of being a resident in the UAE is that capital gain tax are zero, and so that makes the difference between getting 12-14% returns and take away in Italy 27% of that. 27% of 14% is 4 percentage points, so it's a lot of money. So it's the difference between 14% and 10% returns, that tax. So it does make a big difference. So it's a good question, because obviously optimizing for taxation is very important. Is there any other question? And Ryan, is there anything that you thought was not clear that I could explain better? Like anything that was any question that came to your mind that you want to put here?
No, I think everything was very clear to me. Just in case anybody has any clarifying questions, we can wait a few more minutes.
Okay, let's wait a few, kind of maybe another 30 seconds, and to see if there is anything coming up. Otherwise, actually, what I'll do is I'll put Bhupesh contact details back on the slide. For some reason, I can't. What's happening? Okay, let me put contact details back on the slide. So if you have any questions, here he is. You can reach out to Bhupesh, and he'll be able to help you with any question going forward, including if you want you want to opt in as a professional investor and you want to participate to the webinar we're going to do in a couple of weeks. We're going to go a bit deeper into the single products. Some of the content will be similar, but then we're going to go a bit deeper into the products. So I'll leave this slide here, and there's no more questions. So let me just thank everybody for joining tonight. And thank you, Ryan and Bhupesh, obviously, for helping out in a variety of different ways. And again, happy to answer any questions through Bhupesh and through our also support at stashaway.ie address if you have any further questions. Thanks a lot. Have a good night.